Welcome to the HFR podcast. My name is Anika Akhil and I lead HFR Media. HFR is the established global leader in hedge fund data and analysis since 1992. To learn more, visit hfr.com. Welcome to the HFR podcast. My name is Anika Akhil. Joining us today is Dr. Nouriel Roubini, CEO of Roubini Macro Associates, a global macroeconomic consultancy in New York. He's also Chief Economist for Atlas Capital Team and Professor Emeritus of Economics at the Stern School of Business, NYU. Dr. Roubini's insights and analysis are widely regarded in the financial markets. He's a prolific writer and public speaker and captured worldwide attention when he correctly predicted the 2008 financial crisis. From 1998 to 2000, he served on the White House Council of Economic Advisors and then at the U.S. Treasury. He's regularly consulted by the IMF, World Bank, and major public and private sector institutions for his expertise. Dr. Roubini, welcome to the podcast. It's an honor to have you with us.
A great pleasure being with you today.
So let's dive right in. There's widespread sentiment that a Trump administration is good for business in the financial industry. Do you think that's justified, and what are the pitfalls, if any?
Well, it's partially justified. I think that some of the economic policies of the Trump administration are going to imply higher economic growth and lower inflation and being good for financial markets, while some of the other policies might be causing higher inflation and possibly lower growth and being stagflationary. It'll be bad for the bond market, for the stock market, and for financial market overall. Now, on the positive side, I would say there are several things that you can say are going to go in the right direction. One is going to be overall pro-business. Pro-business means that business sentiment is already improving, call it animal spirits, more capital spending, more production, more M&A activity, more IPOs. That's one. Two is going to try to make the tax cuts of 2017 to reduce taxes on labor income and on corporate tax rates permanent, and having lower tax rates, everything else equal, is positive for economic activity growth and for the markets. Three, he has a broad agenda of deregulating the economy. If it's done right over time, that can increase growth, can increase competitiveness, can even reduce inflation. Four, and more controversially, is skeptic about global climate change, and he wants to supercharge production of fossil fuels. There's a plan to increase production of U.S. Oil by 3 million barrels a day by the end of his administration. If he were to be successful to do that, lower energy prices imply lower inflation and having energy-intensive production activities being boosted. And of course, even the booming AI, we're going to need a lot of more energy and electricity. Five, this DOGE, Department of Government Efficiency, can help. They're not going to be able to cut spending by $2 trillion, but there's plenty of waste in the federal budget. I'll give you just one example. When SpaceX sends rockets and satellites in space, they can do it at a fraction, 5 times less cost than what it costs doing it with NASA. So even in the defense budget, there's lots of waste, and involving the tech sector and private sector can lead to efficiencies. And finally, U.S. potential growth is probably already rising because of AI, robotic, automation, machine learning, LLM, and lots of other technology of the future. Is not just AI. And if you are having the help of tech leaders like Musk, Peter Thiel, and lots of other ones, then you can bootstrap even faster that technological innovation. So that's on the positive side. On the negative, what are the things going to potentially cause higher inflation and lower economic growth? Number one, of course, tariffs, protectionism, and a full-scale economic war with China. Two, if you had draconian restriction to migration and mass deportation, that would reduce the labor supply, will cause lower growth, and is going to cause higher inflation. Three, his plan on the fiscal side implied that between the extension of the tax cut of 17 and lots of other promises. No taxes on tips, on overtimes, on social security benefits, on the income of US citizens residing abroad, and so on and so on. All these things have been estimated to cost over a decade $8 trillion per year. If that were to happen, then bond yields will go higher. That's going to crowd out economic growth. That excessive unfunded fiscal deficit. That's going to be a negative. Four, there may be plans to have a significant depreciation of the dollar over time. If that were to happen, will be inflationary. And five, some people within the Trump administration are trying to reduce the independence of the Fed, maybe try to nudge them to ease more and faster, even if inflation remains higher. If you were to tinker with Fed independence, inflation expectation would rise, and that would be also negative and create uncertainty in financial markets. Now, those are the forces that would go in the direction of higher inflation and lower economic growth. And there's also a range of issues having to do with geopolitical risks. And I think that some of those geopolitical risks might become less severe under Trump, maybe a deal between Russia and Ukraine, maybe a deal in the Middle East, but other ones like the tensions between US and China may actually escalate over time. Now, the good news might be that the more stagflationary policies of Trump's are going to be constrained. One, they're going to be constrained by market discipline. I would say that if his policy will lead to higher inflation and higher real yields because you have runaway deficits and debt, or you have restrictions to migration and or high tariffs, then bond yields are going to go higher. The financial conditions are going to tighten. The stock market is going to correct, and that can weaken economic growth. And there's one thing we know about Trump. He likes to have a stock market is rising, and being one that is like that, doesn't want high interest rates and cost of capital and cost of credit. So market discipline and bond market vigilantes can also constrain the worst aspects of the economic policy of Trump. Second constraint is going to be the Fed. If the policies of Trump were to go in the direction of increasing inflation rather than reducing it, tariff migration, runaway deficits, tinkering with the Fed independence, weakening the dollar, the Fed next year may cut rate less, may even stop cutting rates in an extreme scenario where core inflation goes higher with high tariffs. They may even decide to increase interest rates. And we're already in an economy that is more in a no landing zone rather than a soft landing. Growth is excessive, above potential. Inflation has not fallen to target. So that will be a constraint. If the Fed is still independent, decides to raise rates or not cut them as much, that's going to be a headwind to the economic plan of Trump. Three, some of his economic advisors are mainstream. The choice of Scott Bessent as the designated Secretary of Treasury is a good one. He understands economics, macro, financial market. He knows that runaway deficits are going to be bad for economic growth and the stock market, the bond market. So he can push on trade to escalate as a way of de-escalating. But then there are other members of the administration. Peter Navarro, a real hawk on trade and on China, has been chosen to be a trade advisor to Trump. He's going to push for full economic war with China and massive tariffs against the rest of the world. But hopefully, those who are going to argue that it's better to be cautious, not to rattle the market, are going to have the upper hand. So the net of it is that there are some positives, there are some negatives. I think the impact on growth is a bit of a wash next year. The positive are going to be compensated by some of the more negative policies on trade, migration, and deficits are going to push bonds higher. But overall, I would say the path of inflation is one that's not going to go downward towards 2%, but inflation for this year might end around 2.8%. May not be as high next year, but still going to be well above target, say 2.5, 2.6. That implies that the Fed may have to cut rates less than 100 basis points next year. So The overall impact of his policy on growth is a bit of a wash. Growth next year is going to be still above potential, maybe 2.5, but not as strong as this year, 2.8%. But the progress towards reducing inflation might be slowed down because of migration, tariff, and fiscal policies. And that's going to imply some rise in bond yields. It's going to be something of a headwind, not only modest to the stock market, meaning maybe single-digit returns on U.S. equities next year, as opposed to the very, very high returns we've seen this year.
Professor, if I understand your answer correctly and I understand the contingencies, there's a market discipline aspect to this. There is the potential, high probability of the inflationary pressure continuing. And you, of course, have policy experience as well. If I were to ask you to put your policy advisor hat on, imagine you were part of the new administration coming in. What recommendations would you make to the incoming administration to mitigate the risks in terms of inflation, in terms of growth being a wash, and potentially also the labor policies and trade war with China that you just outlined?
Well, what I would suggest to them will be that on tariffs, really try to escalate as a way of de-escalating. So you threaten tariffs, but then you sit down with the EU, Japan, South Korea, Taiwan, other friends and allies in the world, Mexico and Canada, and say, what are your concerns? So you may ask them to spend more on their own defense for NATO and friends and allies in Asia. You ask them maybe to spend more on buying US weapons if they're going to spend more on defense. You can ask them to buy more of the US natural gas, LNG, which is going to be produced in high supply and to be exported to the rest of the world. Maybe buy more of their agricultural goods, and maybe to make sure that tariff rates are parallel, same tariff rates we impose on them that they impose on us. Maybe to do more FDI in the US, semiconductors, cars, electric vehicles, as opposed to imposing tariffs. And there are some bilateral issues with Canada and Mexico. Of course, migration is a sensitive one. With China, the fentanyl issue is a very serious one. And then eventually, I don't think in the first 2 years, but there could be also an agreement on currencies that Trump is going to go and have a big, what they call it, the Mar-a-Lago agreement on currencies. Why Mar-a-Lago? Because all the currency agreements in the past for just currency have occurred in a resort. The Plaza Agreement, the Louvre Agreement, the Camp David Agreement, the Bretton Woods Agreement. So maybe convening a big conference in Mar-a-Lago to convince European Asians to let their currency appreciate and let the dollar depreciate in exchange for not raising tariffs. So those are the kind of things. So I would say that friends and allies of the US should actually engage with the US, say, what are you worried about? What can we do to help you? As opposed to threaten trade wars, because, you start a tit for tat, the US is going to double down. And since this country are all running trade surpluses with the US, on net, they'll be losers. So it's better to engage Trump. And we already have seen it. He threatened tariffs against Canada and against Mexico. Trudeau goes to Mar-a-Lago. There are nice dinners together. Okay, let's sit down and figure out how we can help you. The new president of Mexico had a cordial conversation with Trump. How can we restrict migration and help you on other things that you care about? So hopefully those who want to escalate as a way to de-escalate, Scott Besson and others are going to have upper hand. That's one thing. On migration, I think that, of course, we don't want to have undocumented workers coming US, but we need these workers. Supply of labor is not sufficient. There are many Americans who don't want to do the job in agriculture, in construction, even in provision of services, Uber Eats, or you name it, that migrants are providing. So if you want to restrict migration, let's avoid mass deportation. Let's make sure that a smaller number of people enter in US, but let's have a system like Canada or Australia where we give you points based on your skills, your education, your human capital, the need of different sectors of the economy. We still need at least a net of 1 million people to increase the labor supply to migration in the US. We don't want to have it zero or net negative with mass deportation. That'll be a mistake. It's going to actually increase inflation and reduce economic growth. And on the deficit, I would say, if you want to make tax cuts, permanent, fine, but find ways that you can pay for it. Some of it might be tariffs, but you don't want to go hardball with tariffs. Some of it might be reducing some of the excessive subsidies to the green energy that came from IRA. Some of it might be some spending cuts that are going to be recommended by this Dodge Commission, but try to essentially make sure that our deficit is 7% of GDP, is on a path of reduction gradually over time. If it stays high, eventually the bond market vigilance is going to wake up, bond yields are going to be much higher, going to crowd out economic growth. So on each one of these things, be cautious, keep the Fed independent. If you want to replace Powell in 2026, choose a mainstream person like Kevin Hassett or Kevin Warsh. Don't try to go for a full dove. The market is going to punish you. And be careful about the dollar, because there are fundamental reasons why the dollar is strong. They have to do with your tariffs, with maintaining the global reserve currency or of the dollar, relative growth rate differential between US going strong relative to other 10 countries, relative monetary policy, as other countries will have to cut rates more than the Fed because we'll have still sticky inflation. So keep the dollar strong rather than trying to have a disorderly fall of the dollar might lead to massive capital flight and a surge in bond yields. So, and then do more of the policies that are having a more positive effect on economic growth and reduce inflation. Now, one of them, that is energy policy, I think it is to reduce maybe fossil fuel prices, but it's going to stop the process of decarbonization. We still need a green transition. Climate change is a problem. So phasing out or repealing IRA, I think will be a mistake. Maybe you want to reduce the number of excessive tax subsidies that came from IRA, but you don't want to repeal altogether IRA. We need fossil fuels, but we also need green energy. And actually, a lot of those subsidies are going to red states, and many of these Republican states are not going to be happy with a full repeal of the IRA.
Right. So I want to touch on this climate-friendly policies. Last week, November 20th, more than last week now, 2 weeks ago, you launched the Atlas America Fund ETF and, quote, designed it as an enhanced fixed income alternative, multi-asset diversification tool. And one of the key areas that it invests in is climate-friendly initiatives. Why do you feel now is the right time to launch this ETF? And can you elaborate on the underlying investment strategy a bit for us?
Yes. Well, I do believe that you are in a world where gradually average inflation is not going to be 2%. It's going to be higher because both the Trump policy that I described and more broader trends that I described in my book, mega threats, implied that there are going to be a number of negative aggregate supply shocks, going to reduce growth and increase inflation, geopolitical fragmentation, deglobalization, de-risking, decoupling, going from offshoring to reshoring to friendshoring, population aging, restriction to migration, climate change, global pandemics, cyber warfare, de-dollarization, backlash against liberal democracy and pro-labor policies. These are all medium-term negative aggregate supply shocks, imply higher inflation, lower growth on the supply side. And on the demand side, we have already very large budget deficits. They're going to increase more. Everybody's going to spend more on defense. Everybody's going to spend more for climate change. Everybody's going to spend more to prevent the next pandemic, or the fiscal cost exposure is going to be large. Everybody's going to have a broader social safety net because between globalization and robotics, many jobs are going to be lost. And the rising inequality implies fiscal policy pro-labor. So we spend more. We have limits how much we can raise taxes. Deficits become larger. that become larger, and therefore the incentive to wipe out the real value of long duration fixed income, and that through unexpected inflation is going to also lead essentially to higher inflation. Now, I'm not talking about hyperinflation, not even about high inflation, not even about double digit inflation. I think that by the end of the decade, the average inflation rate in advanced economy instead of 2 could be, say, 6%. So it's a very reasonable hypothesis given supply side negative aggregate supply shock and the need to monetize large deficits and debt. Now think about the market implication. Traditional investment advice is some variant of 60-40, 60 in equity and 40 into a defensive asset. Now, what is a defensive asset? Is long duration treasuries, right? And the logic is that some shocks like growth and risk on lead the equity prices going higher, bond yields go also higher, the price falls, you make money on the equity part of the portfolio, you lose money on the bond, but you on net make money. Risk off and recession, equity correct, but then bond yields are lower, the price of bond is higher, you lose money on the equity leg of your portfolio, you make money on the bond side of your portfolio. Now, this negative correlation between bond prices and equity prices holds only if inflation is low and stable. If inflation is rising, and look what happened, for example, in 2022, rising inflation implies rising bond yields. And rising bond yields implies the price falls. So you lose money on the defensive assets. But rising bond yields, like we saw in 2022, and then again a couple of other episodes in the last 2 years, imply a correction of equities because the discount factor for equities, the bond yield goes higher. So in 22, S&P fell 15%, but actually the rising yield, 10 years from 1% to 3.5%, implied that bond prices fell more, 20%. So you lost more money on the defensive assets than you did on the risky assets. And the correlation between bond prices and equity prices became positive rather than negative. So you lost money on both legs of your portfolio. So in a world where inflation is going to be even slightly higher, bond yields are going to have a brutal drawdown because today bond yields are around 4%, 10-year treasuries. Suppose inflation were to 6 rather than 2%, then bond yields have to be at least 8%, 6% for inflation, and 2% because the real bond yields in a world of high debt and debt are going to be higher. Now, bond yields going from 4 to 8% implies that the price of those bonds are going to fall between 30 to 40%, depending on whether it's a 10-year bond or 20 or 30. So the defensive asset in that world is a bloodbath and is not anymore a defensive asset at a time where higher bond yields are going to imply also a correction of equity. So you need to find an alternative for gradually rising inflation to the defensive asset because the historical defensive asset is not defensive. Actually, you lose money. You can lose money more than equities. So what you do in a world where inflation is higher, where there is a risk of debasement of fiat currency, where there is a risk of de-dollarization, where there is a risk of geopolitical tensions, where there is also risk of climate change making part of our real estate stock being obsolete because of flooding, hurricanes, drought, fires, and lots of other bad stuff happening. First point, you don't want to be in long duration treasury, but short duration, short-term treasury, where the yield goes higher and you don't have the price impact of high yields. 2, you want to be overweight in tips because tips do well in that scenario. 3, you want to be overweight in gold and other precious metals because gold is a hedge against inflation, the basement of fiat currency, geopolitical risk, but more importantly, in a world in which there are geopolitical tension and we've imposed sanctions against our rivals, Russia, North Korea, Iran, potentially China, these central banks have to diversify away from dollar assets. Where can they go? We've seized not just the dollar, but also the euro and the yen, like in the case of Russia. The only liquid reserve asset that cannot be seized in the case of sanction is gold bullion, not GLD, bullion, that you hold in the basement of your own central bank, not in the basement of the Fed or the Bank of England, the basement of the PBOC or the Russian central bank. And surprise, this year gold prices have gone up by over 40% as the central banks, our enemies, but also our frenemies, are worried about our weaponization of the dollar for foreign policy and national security purposes. So gold, good hedge against inflation, debasement, de-dollarization, financial crisis, geopolitical risk. In that world of climate change, the demand for commodity goes higher, especially food, and the supply of food with less water, desertification, climate change, supply is lower, demand is high. You want to be overweight in ag commodities. And in episodes of moderate inflation, not high, real estate does well. But real estate does well because it's in limited supply and you can change rents, both on commercial and residential. But a lot of commercial real estate and residential is at risk of climate change, especially, but not only in North America. And even movement gradual of population going from places that are become too hot or flooded to others are going to imply significant price changes. I'll give you one example. During COVID, many people moved from New York to Miami or from San Francisco to Austin, Texas. That implied that home prices rose in Texas and California, in those cities, by 20%. They corrected by 10% or more in San Francisco or in New York. And that was just a few 100,000 people moving from New York to Florida or from California to Texas. Suppose that a good third of the United States, because of climate change, over the next few decades becomes less habitable. Then you'll have millions of people will have to migrate from the coastlines and the south to the Midwest and parts of the country that is climate resilient. And therefore, the real estate prices are going to fall where climate change doesn't support economic activity, is going to rise. So in the bucket of REITs of our portfolio, we look at the zip level for each one of the zip levels of the US for these REITs, all of them in North America, those that are subject to climate change risk and those who are less subject. And therefore, we don't just want to be overweight in REITs, but in REITs that are climate resistant. So this combination of assets, short-term treasury, tips, gold, precious metals, commodities, and climate resistant provides you a broad hedge and a new defensive asset, because the traditional defensive asset, long-term treasury, is going to do terrible, even if inflation just gradually goes from 2 to 6. It's not going to be defensive anymore. By the way, we have $20 trillion of these treasuries. And on top of treasuries, there is high yield, high grade, in dollar terms, EM debt that is in dollars. All of this stuff is held by sovereign wealth funds, by private and public pension funds, endowment, foundation, other institutional investors, family offices, retail. Everybody has either 30 or 40% in those allocations into something that's going to become more risky. So it's essentially a fund that invests into something of an alternative for the 40 in a 60-40 portfolio. It's going to give you stable, good returns, low volatility, and when some of these tail risks are going to materialize more, there is convexity. The returns could become not high single digits, but could even become double digits in those states of the world.
So you mentioned finding a store of wealth that was safe from fiat currency type risk. The incoming administration is placing its bets quite heavily on cryptocurrency, providing regulatory support with the announcement of the new SEC chair just yesterday. The market has taken this very positively. For Bitcoin, the price went up to 103,000 yesterday. Have your feelings changed at all about cryptocurrency given the strong political support and regulatory leeway that is incoming for crypto?
They've not changed in the sense that, as I pointed out, our goal is to provide a hedge against inflation, the basement of fiat currency, de-dollarization, you name it. If you look even at the experience, say, of Bitcoin for the last few years, when inflation was going higher, actually, Bitcoin was falling, and it was falling when equity were falling, in part because the Fed was raising rates. And now that the inflation actually is falling and the Fed is cutting rates, Bitcoin is surging. So if you want Bitcoin as a hedge against inflation or against debasement, that has not been truly the case. Bitcoin is just a beta relative to the equity market and is positively correlated with equity prices. So it's not actually negative correlated. So if you want a defensive asset, you want a defensive asset that is negatively correlated with equities and one that actually does well when inflation goes higher. And that's not the case for Bitcoin. Now, Bitcoin, by the way, is not a currency. And all these cryptocurrencies are not currencies. They are not a unit of account. They are not a scalable means of payment. They're not a stable store of value. They can go up 50%, fall 50%. In a portfolio, they increase a lot volatility. And they're not even a single numeraire. Even a country like El Salvador that made Bitcoin legal tender, so you have the right to pay a store with Bitcoin, less than 1% of all transactions occur with Bitcoin. That means it's never going to be a means of payment. It's not going to be a currency. And as a store of value, as I said, one is highly volatile, two is positively correlated with equity. So it's not a defensive asset. So we're looking instead in our ETF at a wide range of assets that are actually negative correlated with the stock market. They give you a hedge against those tail risks, and they are having low volatility as opposed to having high volatility. So that's why I remain quite skeptic. Bitcoin is a speculative asset like meme stocks, like SPACs and other ones. And often the retail investor and the retail sucker comes in when there is FOMO, the prices are at the peak, and then a 50% correction occurs and there's a bloodbath. So it's still a very speculative and risky investment. That's why if you want safe returns and stable returns and a good defensive asset, I would not go into Bitcoin.
So, Dr. Roubini, last question for you. I want to take the long view. I want to think about something that's actually been in the news recently with the 2024 Nobel Prize winners. They have done extensive research emphasizing the integrity of institutions to ensure long-term economic prosperity. And many would say that there's increasing alignment between the three arms of government in the United States. Do you think that that poses a threat or a risk to U.S. prosperity, to its institutions and its system of checks and balances? And if so, what is the best way to navigate that?
Well, I think that the U.S. is still a resilient democracy. There have been cases when, of course, you have unified government rather than divided. That's one of them. Of course, also the Supreme Court is overall for Trump. But I think that we still have rule of law. We have strong institutions. We have a strong media and the press. And there may be some authoritarian leanings of Trump. But if you look at the range of the people he has nominated, actually, they've been reasonable. They're conservative, but they're reasonable. And people like Gaetz, that was inappropriate, got out of the race. The nominee for DOD may get out of the race. We're not yet sure whether Patel is going to be confirmed at the FBI. So I think that the institutions are really strong. But it's true that institutions, rule of law, democracy is important, not just in the US, but also all over the world. And it's also true that we've seen in the last few years, all over the world, a backlash against liberal democracy and democratic capitalism and populist parties and regime of either the extreme right or the extreme left coming to power. But some of it has occurred because there has been a rise in income and wealth inequality, and a rise also of economic insecurity. So many people still left behind. So growth is becoming, one, less stable because of boom and bust and financial crisis like the GFC. Growth is becoming less inclusive because while there is economic growth, income and wealth inequality are rising and economic insecurity is rising. And growth has become less sustainable because we are destroying the planet through climate change. So you need policies that make growth stable, inclusive, and sustainable. And but I do believe that there's going to be some degree of resilience of democratic capitalism as long as a reform in that type of direction. But certainly, one of the things I worry about is populism. And populism usually leads to poor economic policies, leads often to build up of debt, leads to debasement of fiat currency through inflation. And therefore, part of our concern is that both the geopolitical trends and the domestic political ones are one in which we're not going to be able to restrain deficits and debt. And eventually, the solution is going to be taken, is going to be using the inflation tax to wipe out the real value of long duration debt. Again, that's one of the reasons why the kind of portfolio we suggest with our ETF is going to be also hedged against economic populism and some of those poor economic policies that over time have been inflationary. So I do not worry about democracy in the US, but I do worry about democracy in many other parts of the world. But I worry that even if our democracy is maintained, economic populism is going to lead to tariff, inflation, debasement, and things that are going to cause higher inflation. Therefore, you want to hedge yourself against those types of tail risks.
Well, thank you so much, Dr. Roubini. Your answers have been thoughtful and thought-provoking, and it's truly a pleasure to have you on the podcast. Thank you so much for joining us today.
A great pleasure being with you today.
Thank you. We hope you enjoyed listening today. HFR is the institutional standard for alternative investing. Subscribe to HFR Media updates on our website, follow our podcast for more exclusive content, and find us on LinkedIn and Twitter.